Licensing your patents. I've sometimes gotten the question from a patent owner, do I need to have a business entity in order to license my patents? Well, the short answer is no. You don't need to have a business entity. Now, some people would argue that having a business entity will protect you from liability. A business entity may protect you from some liability in terms of contracts that you form and expenses that the business incurs versus expenses that you may incur as an individual. However, there's much more involved to shielding yourself from liability with a business entity than just setting it up or having some named entity. You have to comply with what are called the corporate formalities. And I'm not going to get into the details of what corporate formalities are, but I am going to give just an overview of business entities for your general information. So, should you have a business entity in place for licensing your patents? I would say generally, even though it's not needed, it's always a good idea if you're entering into some type of a business arrangement to have a business entity set up. And there's various reasons for that. These reasons are best discussed with a certified public accountant or your business attorney. Either one of those people can provide you with a lot of information about what would be an appropriate business entity to choose and why you would want to set up a certain type of business entity over another. But generally, there are two main types of business entities that you should be aware of. One is a corporation and one is an LLC or limited liability company. For some reason, the majority of people that ask this question always ask about limited liability companies. It needs to be made very clear that how a corporation is defined or a limited liability company is defined under state law. The states determine the rules that apply to corporations and limited liability companies. Taxation that flows from those entities, those business entities, is subject to the United States tax laws that are implemented by the regulations and the Internal Revenue Service, IRS. One thing to know is that corporations have a certain structure in terms of the way the IRS views them, and a corporation can be taxed based on its profits. A corporation can also pay out dividends to shareholders. The shareholders then individually have to pay taxes on those dividends. And if you've ever owned stock or a mutual fund, you know that if you get a capital gain by turning around and selling the shares of that company, let's say you bought the shares at $5 and you turned around and sold the shares for $10, you'd have a $5 capital gain per share, and you would be required to pay tax on that $5 as income to you as an individual. Now, in terms of the way the IRS works, the IRS doesn't care about whether you have a limited liability company. Now, a limited liability company, you can set up as a single person. You can set up a corporation as a single person. But in terms of limited liability company, that's meaningless to the IRS. If you're a corporation, they assume that you're going to pay taxes in a certain way. If you're a limited liability company, unless you file a specific document with the IRS to tell them you want to be taxed as a corporation, you're still going to be taxed as an individual if you're a single member limited liability company. And again, this is something you should discuss with your CPA or with your business attorney to find out all the details. But generally, you as an individual receive income and then pay taxes on that income. So if you set up a business arrangement where you're receiving licensing royalties, you're getting those royalties as an individual and you're paying taxes on that royalty as personal income on your tax return. When you set up a corporate entity, a business entity, what a business entity is a fictional person. So I showed the little stick man here as a dotted line because the corporate entity, a corporation, is a fictional person. So the cloud represents the ownership of the corporation. The corporation has income coming into it. So if you set up a business entity to receive your licensing royalties, those licensing royalties are going to flow into your business entity as income, as gross income to the corporate entity, to the business entity, whatever it may be. Now, the business entity is going to have expenses, and those expenses can be deducted from the income before paying taxes. So expenses of that corporation may be, for example, if you buy office supplies you need that you're using in the business, then those would be deductible as a business expense. But also there may be some operational costs where you have to go out and do certain things in order to seek the licensing revenue, the licensing contract. You have legal fees, you have CPA fees. All of those things are expenses of the business, and then they can be deducted from the income coming into the business. One of the business entity's expenses is a salary of the people that work for the business entity. So if you are working for your business entity as an employee, which is most likely how you would set it up, then you may receive a salary as an individual from that corporate entity. When you file your personal tax return, you're going to include the income you received from the business entity as part of your personal income on your tax return. That salary for the business, from the corporate entity standpoint, the fictional person, that is an expense that's deducted from the gross income, the gross revenue that the corporate entity is receiving from all of its different business activities. The profit is what's left over after you take the gross income and you deduct all the expenses, one of which could be your salary that you're getting paid from the business entity. Whatever is left over becomes taxable income to the corporate entity. Now, one of the advantages of having a corporation is that the corporation, if it has a profit, it can pay dividends to the shareholders. Now, there's a type of filing that you can do with the IRS, which is called S-Corp, and a lot of people don't understand what that means. S-Corp. S-Corporation is a tax election that you make with the IRS. You file a document that tells the IRS, hey, I'm setting up a corporation. I want to be taxed as an S-Corporation. What that means is the IRS is going to treat the S-Corp as what's called a flow-through entity. Flow-through. A flow-through entity. What that means is the gross income that comes into the business, even though you've got a corporate entity set up, when you do the tax return, when you do your personal tax return, the income that the business has after the expenses is going to be treated as personal income to you, and you will be taxed based on the net revenue of that business. Now, if that happens, you might be asking, well, what's the advantage then of having the corporate entity? The advantage is that you can still take a dividend. So the salary that you take is going to be subject to payroll taxes. Now, payroll taxes means that there's withholding. Anybody that's ever received a paycheck in their life knows that taxes are withheld for the state in which you reside, and also for your U.S. taxes and for Social Security and Medicare. So that withholding is still going to happen when you take your salary from the business entity. So a certain percentage of your salary is withheld by the business entity for taxes, and the business entity must pay a share of those payroll taxes. The payroll taxes that the corporate entity or business entity pays are an expense to the business, and so is your salary. Your salary and the payroll taxes are an expense to the business. And of course, you have to pay your share of your taxes as an individual, and those taxes are deducted as withholding from your paycheck. What's ever left over is the profit, and that profit you can take as what's called a distribution. A distribution is just a form of a dividend that you're taking from your business entity. Now, the distribution portion that you take is not subject to payroll taxes. That said, you can't take all of the money of the profit of the corporate entity. You can't take all of your money out as a distribution because that's not allowed by the IRS. You have to take a reasonable salary. So if you take a reasonable salary, whatever is left over, you can take some of that as a distribution. One rule of thumb is your distribution shouldn't be more than 50% of your total income. If your salary is 40% of the profit of the corporation and the other 60% is distribution, that's probably not going to be allowed. And the IRS may go back and reclassify that distribution as salary, and then you would be subject to payroll taxes on all of it. You want to make sure that you have a reasonable salary and that your distribution amount is not more than what your salary is. So if 60% of the revenue was taken as a salary and a remaining 40% was taken as a distribution, that should be okay. But check with your CPA and your business attorney. Don't just listen to some random guy talking on YouTube in a video. Go and check with the certified public accountant and check with your business attorney to make sure you're doing everything the right way, and also make sure that you're doing your bookkeeping the right way, because this is another thing that can lead to trouble. If you're going to set up a business entity, you really need to make sure that you're not commingling your personal income with the business income. And you need to make sure you're not commingling, especially your personal expenses with the business expenses. For example, if you have a business entity set up, you're not going to take your spouse and kids out to dinner and then charge that as an expense to the business. That's a personal expense. It doesn't belong as part of the business expenses. The business expenses are for the business. Your personal expenses have to be kept separate. So you can't be commingling. That leads to another issue. If you start commingling, the liability protection that you wanted to get from setting up the business entity may become null and void. There's a concept called piercing the corporate veil. If you're not following the corporate formalities, you're commingling funds, and you're not doing the other things that are required by state law for you to maintain that corporate entity or that business entity in good condition, then if something does happen where you're subject to some claim of liability for some monetary amount, and it's found that you're not following the corporate formalities and you're commingling money between your personal income and personal expenses and the business expenses, then the entity that's coming after you for the business money may be able to come after you personally for that money, because they can do what's called piercing the corporate veil by showing that you are commingling and you're not following the corporate formalities, and the business entity is just a mask for you as an individual, and you're using that as a mask for your personal expenses or whatever the case may be by doing this commingling. So you want to avoid that. You really want to make sure you're doing everything right. So talk to a CPA, talk to a business attorney. If you're going to get into the business of licensing your patents, look at setting up a business entity for you to be able to receive income from the royalties. But also, you can also set up the business entity. You could set up a business entity during the process of obtaining your patent application, because your expenses involved in obtaining the patent application, legal fees, USPTO fees, international patent office fees, and other things that may be related to you obtaining the patent, could be deducted as a business expense up front, instead of you waiting to the point where you've gotten the patent and now you're going out to license it. So business entities are something you should think about early rather than later. If you're in the patent process, you should think about it even before filing a patent application, so that you can use that business entity to conduct business even with the attorney, in terms of how you classify, how you categorize your legal fees into USPTO fees. Those can all be business expenses. In fact, your invention process, your product development process can be a business expense. You can set up a business for developing your invention, and the costs that you have, the expenses that you have related to developing your invention, and the supplies and materials that you need to build prototypes, or any activities that you're doing around building your product idea or building your invention idea, can be business expenses to that business entity. Later on, when you go to license, you can use that business entity to be a vessel for receiving the royalty income and other income that you may receive from product sales or whatever, depending on how you decide to proceed with your business. So business entities, are they necessary for patent licensing? No. Are they recommended for patent licensing? Yes. And these are some of the reasons why. There are others. Again, talk to your CPA, talk to your business attorney, take a close look at what you need to do, both when you're developing products and when you're thinking about patent licensing activities.